Welcome back to the exchange. Morgan Stanley out with a new note this morning saying that mega cap tech stocks are the most underowned, at least amongst actively managed funds, in more than 16 years. The gap between portfolio and S&P weightings widening significantly in the second quarter. The firm argues this could actually be a good thing for the sector. Joining me now to discuss, one of the analysts behind the note, Erik Woodring. Erik, I know you don't cover all these names. I think you do cover Apple, so why don't we start there? I can understand why, if you're running an actively managed portfolio, you don't want to own Apple. I mean, it's not growing its top line, or to be fair, last quarter was stronger. Doesn't have an AI strategy. It may still be under pressure from tariffs, although that doesn't appear to be the case. So, why is that an opportunity, in your opinion?
Sure. Thank you for having me on, David. So, one thing, if we just take a big step back, most of the mega caps are generally underowned. If we think about their relative weighting in the S&P, which is the index that we base this analysis off of, these are very big stocks with very big weightings, and sometimes you get too concentrated if you own a number of these. So naturally, investors, active managers, are underweight the mega caps, even the NVIDIAs of the world that have obviously had their amazing run. When we drill down on Apple, David, many of the points that you just made are correct. Top line growth has been relatively tepid. Apple is faced with a number of kind of either geopolitical or regulatory headwinds that they've had to work through. And so on a look back basis, again, the underweighting is clear. Why institutional investors would be there. Going forward, though, I just think the narrative feels a little bit different to me. And this is what we wrote about towards the end of last week, which is the combination of three things gets me to feel a bit better about the stock as I look out over the next 12 months. One is obviously dodging a major risk in Section 232 tariffs. That could have been up to 10% EPS downside. Instead, it's effectively a non-event. The second one, go back to earnings, and to your point, David, the core of the business, even when you normalize for pull forward or one-timers, was just better than we expected, both products and the services business, importantly. And then the third leg of this stool is, as we look out, we're getting a little bit more kind of breadcrumbs, so to speak, that there is some semblance of strategy for AI at Apple, meaning we're seeing a bit of a CapEx uptick. It's not significant, but it's moving in the right direction. You hear the Tim from Apple. To me, his tone today is very different than 3 or 6 months ago. And then you get reporting that Apple is potentially, working on their own second generation of AI technology,
right?
Partnered with the potential of partnering.
Yep.
So it just makes you feel a little bit better on a look forward basis.
I get it. And we'll all see if we ever do get that deal that many speculate, although who knows. When it comes to this broader theme, though, in terms of actively managed portfolios, trailing the benchmark or the index, what it would be. For example, NVIDIA, I think 7-8%, right, of the S&P. So
right.
Is there going to be catch up? And by the way, it's been very different this year. They haven't all performed similarly. I mean, you've got, Microsoft and Meta and NVIDIA way outperforming the S&P, but then you've got Alphabet and Apple, which we just talked about, obviously, and Amazon underperforming.
Yeah. And so we've seen the degree of relative underweighting change throughout this year, which if you take that into account, you can kind of bifurcate between those that have outperformed and those that have performed in line or underperformed. But generally, all of the five mega cap tech names have been underweight this year. Meta has been the one exception. Meta has actually been over-owned relative to its index weight for the majority of the last 4 years, up until the second quarter. It is now under-owned relative to its weighting, as it's had quite a nice run. And so we do need to kind of look at the starting point from the end of last year to where we are today. And using Apple again as an example, starting the year, Apple was the most under-owned stock. It is now the third most under-owned stock, as the stock has underperformed,
right?
But investors haven't necessarily cut their positions as much, and so that helps to explain the disparity. But the high-level answer is, on average, mega cap tech is underowned by about 140 basis points exiting 2Q. Exiting 1Q, that under ownership was about 115 basis points. So we are more underowned than 3 months ago.
Right, and so perhaps there will be a return to making that more even.